Welcome to Riches in the Niches Investor Podcast. Here's your host, my dad, Richard Sosa.
Welcome to the Riches in the Niches Investor Podcast. This show covers investment opportunities in markets that are relatively unknown to the average investor. Through in-depth conversations, we learn how money managers, company executives, and other leaders build an edge one niche at a time. I'm your host, Richard Sosa, and this is Riches in the Niches. Today, I have the pleasure of sharing my conversation with Yaron Naymark, founder and portfolio manager at OneMain Capital. OneMain is a boutique investment firm that makes concentrated investments in high-quality, reasonably valued businesses with long reinvestment runways. They also invest in special situations with asymmetric risk-return profiles. Listen in as we discuss Yaron's background in entering the investment world, what led him to start a fund, and how he sees great opportunities in what he calls secular cyclicals. Let's niche down with Yaron Naymark. Yaron, thank you very much for joining our program. Can you tell our listeners a little bit about yourself? We would love to hear your story.
Yeah, thanks for having me on. Appreciate all the listeners taking the time to hear my story as well. I am the founder and portfolio manager of a small, and growing fund called OneMain Capital Management. We've been in business since early 2018, so I launched the fund in February of 2018. Before that, I'd spent over a decade working, in various buy-side roles, and before that, starting in investment banking. The buy-side roles, I was at two different long-short equity hedge funds. Before that, I was at a lower mid-market, value-oriented private equity fund in the LBO group. And so, I have a long career and kind of experience in terms of investing and evaluating businesses. But even before my career, I grew up analyzing businesses. My parents were, I'm first generation American. My parents moved here a few years before I was born to the States. They had a very small business when I was growing up, selling towels and stuff to tourists in South Beach with a small little retail store. Before that, my dad sold electronics at the local flea market in Miami. But they had friends who had much larger businesses, manufacturing businesses, real estate businesses, services businesses. And so I was exposed to these business owners growing up, and I was always interested in what they were doing, how they were thinking about the world. After family dinners, all the kids would get up and kind of leave the dinner table and go play games. And I would sit back and listen to their investment decisions, their personnel decisions, working capital management conversations. Just I was always intrigued in what they were doing to make money, how they were thinking about the world from a business standpoint, from an investing standpoint, managing their employees and the likes, and trying to grow their wealth. I grew up with a family that we didn't, we definitely were not lacking of anything financially that you need, but there were lots of things that I wanted growing up that I couldn't get the new pair of shoes every year for school that I wanted. And, there were certain, all my friends who would get new clothes every year. I was like, man, I really want, these pairs of jeans. And my parents would be like, if you really need it, we'll get it for you. But it's kind of expensive. And I just didn't want to grow up feeling that way. And so I always had this hunger for money. I had a family member who was very, very wealthy, who I watched lose it all through the dot-com bubble. And so not only was I hungry, and I saw people succeed, but I saw people fail very early on. And I always tried thinking what I can do to ensure my path to success and not blow myself up. And so, I read the Buffett letters in college. I started reading hedge fund letters. I've been watching YouTube interviews of hedge fund managers my entire career. And I'm just really passionate about investing. I'm passionate about studying businesses. I'm passionate about studying and evaluating management teams and making calculated bets, whether they're short-term bets or long-term bets, and getting better over time. And so I just feel really fortunate that I've put myself in a position at this point in my career where I'm still relatively young, where I can kind of go out on my own and practice the craft and refine it and hone it and get better over time. And I think I'm getting better every year, but I think I'm pretty darn good today. And that's kind of my background and how we got to where we are today.
So you knew pretty early on that you wanted to be in business, an entrepreneur.
Definitely. So I knew I was passionate about investing. I knew I was passionate about business. I didn't know how that was going to, make its way into a career for me. I didn't really know what hedge funds and private equity firms were when I was in high school. I grew up in Miami, not in the Northeast. So I wasn't exposed to this whole like Northeast finance community. I was exposed to, school of hard knocks type business people. My parents' friends who had very large businesses, none of them had college educations. They all kind of, just fought their way into the businesses they were in. And, I knew I wanted to end up in some investing, some business type role. But growing up in Miami, I didn't know exactly what that would be. I stayed in state for college at the University of Florida because I had a full scholarship there, and I was just thinking about not taking on a lot of debt through school. Um, and even my first 2 years in college, I think in people who are in schools in the Northeast, um, I think this might be changing now, by the way, but people in the schools in the Northeast, even pre-Twitter and all these message boards where you knew what career you wanted to go on and you can kind of see the path that you need to take to get to where you want to be. When I was at UF, no one was really talking about investment banking our freshman and sophomore year. Whereas if you went to Harvard or Penn, your freshman year, you saw sophomores, juniors, seniors competing for internships, competing to get their resume looking right, competing for this private equity job right out of school. And I just, I would wake up early. I'm an early bird. I would try to find message boards of like careers that paid six figures coming out of school. I was like, man, if I could make, six figures coming out of school, I've made it. And I read about this investment banking thing. And I was like, man, I need to start in investment banking. This is my path. And I went on all the bulge bracket websites, their career sections, and I filled out applications. And I'm like, they have to get 10,000 of these. There's no way they're ever going to look at my application. So I need to figure out a way to get in front of them. And so I would, cold email people on the HR departments, alumni from University of Florida, and say, hey, I applied online, but like, can you get me a conversation with HR? A lot of them were like, I've never met you, but if you're ever in town, let's grab a coffee. So I would fly up for a coffee so they could meet me and see that I'm a good guy and that I'm a smart guy and that it's worth, them sticking their neck out for me. And so I was able to get some interviews. I was able to convert those into internships, and I was able to convert those into full-time jobs. But I feel very lucky that I found that, that path coming from University of Florida where like people just we're not a target school. These banks don't come recruit from the University of Florida. So you kind of have to fight your way into it. And, for someone who didn't even know what it was my freshman or sophomore year, I feel very lucky that I found it my junior year and was able to kind of in that short window, fight my way into a position that let me kind of grow my career to where it is today.
The harder you work, the luckier you get. This was something that was always told to us as growing up.
Yeah, I think it's true. Look, I'm not one of those people who says, it's I got here all because of hard work and my brain, my intelligence. I totally know I'm very, very lucky. Not only that I found this path, but that I was able to fight my way into the path, right? Because lots of people from non-targets, um, it's there's not that many seats, and so even coming out of investment banking to get into private equity, I was looking for private equity jobs in the summer of 2009, early 2010. Um, it was right after the financial crisis. Credit markets were still shut down pretty much in the summer of 2009 for new buyouts. Um, LBO firms were licking their wounds from old private equity deals they did in 2006 and 2007. So they weren't hiring a lot of people. And I knew I wanted to move to private equity, but I also knew, I'm not from Goldman, I'm not from Harvard, and they're not hiring that many people. So, like, what are the odds I get a seat at a good private equity firm? I didn't even get interviews at private equity firms. I had to, for that as well, similar to banking, I had to reach out and kind of beg a friend who had a sister who worked at KKR to vouch for me and say that I'm worth taking a shot on. And I met with KKR. I think I did fairly well in the process, but I remember I had one meeting with one senior guy there after a bunch of good meetings with more junior guys where he asked me some question that I bombed. I'm not even going to get into the details of the question, but I bombed it and I knew I was better than that. And I'm like, man, this is going to be my one shot to get a private equity seat because headhunters are not giving me the time of day, right? They're giving the time of day. There's a few seats. They're giving the time of day to the Harvard Goldman guy, not the UF City guy. And so I thought I blew my shot. And I'm like, if I just get one more, if I get one more opportunity, I will prepare and I won't bomb anything. And then I got an interview at a firm called HIG Capital, which today is a $50 billion firm. It was like 6 or 7 billion when I joined. Amazing private equity firm, really smart people, amazing investors. Feel very fortunate that I got that opportunity. But for that, I prepared and I was like, I'm not going to miss any question. I was ready for anything. And then in one of the more, one of the later stage interviews, one of the more senior guys, he asked me where the NASDAQ was. And at that time, I wasn't following public markets really that closely. So, I was interviewing for private equity and I was like, I don't know where the NASDAQ is. He's like, okay, where's the Dow? And I didn't know where the Dow was. And, I walked out of that thinking, oh my God, if I don't get this job because I didn't know where the NASDAQ or the Dow was, I'm gonna jump out of the window. And then, the most senior hiring partner met with me and he asked me how I thought the day went. And I told him I thought it went really well, except for the NASDAQ and Dow question. He's like, don't worry about that guy. He was just messing with you. And so I feel really, it's all a matter of luck. Like anyone could ask one question that could bomb you on any interview. There weren't that many opportunities for me to even interview for, so I was lucky to even get those 2 interviews. And so I think I'm a hard worker. I think I'm smart. I think, I don't feel bad about having what I have, but I also don't feel like I deserve everything I have. I totally understand how fortunate I've been.
Can you give your quick thoughts on some of the differences between investment banking and private equity?
Investment banking advises companies, including private equity firms, on major, capital market financial type decisions, whether it's making acquisitions, selling assets, financing those assets that you're buying or selling. They're basically a one-stop shop brokerage for debt, equity financing, and helping advise on financial decisions. In terms of private equity, you're on the other side of the table. You're getting advised sometimes by these investment banks, but you also have to make obviously the buck stops with you. You make the decisions on your own, but you're buying a control position in businesses that are getting sold by families that are looking to monetize their life's work in some way, businesses that are getting sold by other private equity firms, businesses that are getting sold by public markets that are either selling the entire business or a division of the business. And you spend a lot of time evaluating these potential acquisition targets to try to really understand what you're going to own. Because at the end of the day, it's not like public markets where you buy something and you learn new information a week later and you could change your mind and get out. In private equity, it's very illiquid. Once you buy it, you kind of own it for a very long period of time. And so private equity is a great place to start your career in investing because you have to do very deep diligence and really know what you own going in. And so I think, private equity is a great place to start the investing career. Investment banking is a great place to start kind of understanding how capital markets and financial decisions are made, corporate decisions. How to start your careers there. Look, I think if you know very early on you want to pursue one of these paths, it's much easier because you can make sure you apply to the right schools, which are target schools, which tend to be these Northeastern, Ivy Leagues, maybe Stanford, Michigan. They're Duke, very specific schools that banks like to recruit from. And you can start to kind of pad your resume with good sophomore internships and freshman internships and network very early on. And if anything, now Twitter has made it a lot easier. I think, I get emails all the time from people at what we would consider non-target schools that are thinking about how they're going to break into Wall Street and finance and hedge funds and private equity. And I think Twitter has kind of opened people's eyes and doors a lot more to making people understand what they need to do to get to where they want to be. So I'm happy. I always try to answer as many emails and messages as I can when I get them from younger kids because I really, I can relate to a lot of them, ones that are in those seats that I was in 10, 20, 15 years ago. And so if anyone has any questions, please reach out. I'll try to get to it. If I don't get to it right away, reach out again and again, because a lot of times when I see a second or third email, I'm like, man, I really need to answer that. It's not fair. So I think, you got to be hungry. You got to get lucky. You got to have a couple things go your way. But I would encourage anyone who's interested in investing to pursue that path.
Yaron, what led you to start your own fund?
I grew up around small business owners. I always wanted to have my own business. At the same time, I grew up reading, the Buffett letters and all these, watching hedge fund manager interviews and pitches, and I knew I'm passionate about investing, namely analyzing and studying businesses and management teams. But I also wanted to run my own business, and I thought that starting my own firm, an investment management firm, would kind of bring those two together. Um, I knew day one that I wasn't going to be one of these big launches spinning out of Viking or something like that, launching with $1 billion. I knew I was going to be a subscale launch. And so I was scrappy, like a lot of young emerging managers are. I kept my overhead very low. I was fortunate enough to have saved up, some money in my working career before starting the fund. So I had enough money to put into the fund and also enough money to keep outside of the fund to cover living expenses for a few years, of making no income, basically. And I knew I would need to put my head down, prove out my strategy, prove out that I know how to manage risk and manage a portfolio and pick stocks. And that once I did that for a few years, I would start raising money. And that's exactly how it's played out. I feel very lucky, that it's played out the way it has. Again, I think I'm a good investor, but some people start, you know, their fund right before Lehman Brothers collapses or right before COVID. And, it just, a lot of it's timing. So I started the fund in early 2018. Right after I launched, we had that Volmageddon. So I started down out of the gate and I was like, man, this sucks. But was able to claw my way out of that initial hole. Then, later that year, we had the trade war. And then, we had COVID in 2020. And I've been very fortunate to navigate those periods of turbulence in a way that I feel proud of, that in a way that have made me more confident in myself and being able to manage risk and construct a portfolio that could work in various market environments. And I think those results kind of have helped me start picking up on the marketing and fundraising side. So, day one was my personal capital, a few former bosses of mine from various firms. We were a handful of investors. First year, I didn't really raise any new money from new investors other than my day one investors. And now, we're raising money from a handful of new investors every month. And this is going to be our biggest inflow month to date, October 1st. And so, I'm happy I went down that path. And that's kind of how I thought about building it.
Can you tell us a little bit about your strategy?
The way I always start describing the strategy is to compound my capital, because my capital, almost my entire net worth is in the fund. My capital along with my LP's capital, at an attractive of a rate as possible without going far out on the risk curve. So number one, I'm trying to avoid, taking any permanent impairment risk on our capital. Number two, I'm trying to compound it at an attractive of a rate as possible over time. The way I do that is by investing primarily in what I like to call core investments, which are high quality, predictable, growing, reasonably valued on earnings or free cash flow, well run and well capitalized. And so I like to buy, positions and businesses that are in end markets that tend to be outgrowing GDP. I like those end markets to be rational. So oligopolies, monopolies, a few competitors that are rational and don't, I don't like when, in an airline, for example, Delta's profits are not purely dependent on Delta's management's decisions. It's that they're dependent on what the price of oil does, what the competitors do in terms of their pricing. And so I don't like industries that, they don't control their own destiny. So I like industries that are outgrowing GDP. I like them to be in rational end markets where the company I'm investing in is competitively advantaged within that industry and is one of the leaders. It's important for me they're well capitalized so that these businesses could play offense when others are playing defense. They're well managed so the management teams don't make decisions that destroy a lot of value for us. And I want them to be cheap on earnings or free cash flow 3 to 5 years out. I'm typically looking for 25% plus IRRs on those investments. And once I find those, they're not that easy to find. I sift through a lot of companies to find them. Once I find them, I tend to size them at around 5 to 15% of the fund's capital. They'll be closer to 5%. If I'm newer to the name, I'm still getting to know management. If I'm less confident in my projections. Um, or if they're valued in a way where I think, the 3 to 5 year IRRs are 25%. And as my 3 to 5 year IRRs kind of increase to 30 and 35%, and as I get more comfortable with management and the business quality and my understanding of the key drivers, I'll increase the size to 10 to 15% of assets. So, we have 15-ish cores in the portfolio today. The top five probably make up, over 50% of the fund. But on a 3 to 5 year out time horizon, I'm very confident in what these businesses look like. I'm very confident that I'm paying a multiple where it's going to be hard for me to lose money permanently if I'm right on business, which I think I am. And so I think if I'm wrong on anything, instead of compounding at 25 to 35% IRRs, my disappointing case would us be compounding at 10% IRRs, which I could live with. But we're not buying stuff where I think we could actually lose, 10 or 20 or 30% of our capital on a permanent basis. And so a vast majority of the portfolio is in those cores. And then we have what I call the opportunistic bucket, which on the opportunistic front, it doesn't need to have any of those characteristics that the cores have. It could be highly leveraged. It could be poorly run. It could be in a bad industry structure. We could be looking at warrants. We could be looking at litigation securities. We're willing to kind of lose everything we put into an opportunistic. When we buy an opportunistic position, we are fine with it going to zero. We don't want it to go to zero, but we're only putting 1 to 3% of the fund's capital into it. And the only way we're putting 1 to 3% of the fund's capital into something that could conceivably go to zero is if we make, much higher convexity to the upside type returns, if I'm right. And so what we look for in opportunistic type bets is we're looking for 5 baggers or more. We're looking for them to be over a shorter duration. So, in the core positions, we are underwriting 25, 35% IRRs over 3 to 5 years. Opportunistic, we're looking to make 5x or more over 18 months, call it 12, 18 months, something like that. And so we don't find a lot of those. I don't go out hunting for opportunistic situations. They tend to pop up tangentially when I'm looking at cores. There's something I already know. There's something someone pitches to me that I think is interesting. But, if someone pitches me something that's a special situation, not a high quality business, not well run, not in a good industry, and they're like, man, this is an easy 50% in 3 to 6 months, an easy 100% in 3 to 6 months, I don't even look at it, right? The bar for looking at those, things that I think could go to zero conceivably, is very, very high. And so we have 1, 2, maybe 3 of those in the portfolio at any given time. And so, again, a vast majority of the strategy has been in what I call core positions. We have a tail of opportunistics, and we've made good money in both. We've had some really big winners on the opportunistic side, but most of the bread and butter has been on the core side. And I think it's a pretty well-rounded strategy that has proven itself so far over 3.5 years, and hopefully will continue to do so over the next 5 to 10.
How do you source your ideas?
The way I source ideas is probably pretty similar to the way a lot of other managers source their ideas. I run screens, I read Barron's, and I read Microcap Club posts and Value Investors Club posts. I speak to my friends who work at other funds. But I would say the overarching theme is that of sourcing ideas is that I'm naturally curious about businesses. And so when I hear someone pitch something, I want to understand what that business does, why it does it that way, what I think it could be worth over 3 to 5 or 10 years if they do what they say they want to do. If my wife uses a new product that she loves, if our friends are using a new service that they love, that they're talking about nonstop, my mind immediately goes to, what does that business look like? How big is the addressable market? What does the end market structure look like? Is it a good industry? Do they make good margins? Is it very capital intensive? What would it be worth if it was public? Is it public? Okay, let me go check. Is it public? And so, I think the same way that curiosity leads me to run screens, even when we're close to being fully invested, is because I want to find more potential investments that could replace existing ones or that I could study for the next 5 years and maybe they'll make their way into the portfolio. I'm curious when people pitch new products or services to me, even if it's not a stock pitch, it's just a I love this new thing pitch. I read a lot, and so they come from anywhere. At this point, I definitely have a watch list of names I've been studying for a long time that are not at the price points that I'm hoping to buy them at. And I continue to study those businesses continuously because, one day they might hit that price point where I'm willing to buy them. And so I have a big watch list, but I'm always looking to add to the watch list. And my curiosity kind of just makes that a fun process for me where it doesn't feel like work.
So let's say you see a new stock and it's interesting. How long does it take for you to either buy some stock or make it a real position?
On the core front, it's a much longer process. Again, for cores, there's a lot of boxes that need to be checked for me in terms of understanding the end market, understanding the management team's incentives, understanding the business, what the key drivers of the business are. And typically, because they're higher quality businesses, um, they tend to be priced in a way where like you have to really be willing to look 3 to 5 years out and have a little bit of a variant view. And it takes time to develop the conviction in that variant view, right? You're not going to find these businesses that are that check all these high quality boxes. You're not going to find them at 12 times earnings and be like, this is a no brainer. I'm buying it today. You kind of have to follow them and really have conviction in modeling above consensus numbers 3 to 5 years out, or maybe they have no consensus numbers and modeling the business out over 3 to 5 years and having conviction in those numbers. So it's a slower process. It's iterative. Um, on the opportunistic side, I sometimes move much more quickly. Quicker in, quicker to blow out if something changes or if I'm proven wrong. But because of the asymmetry, I'm motivated to move quickly. I'm willing to kind of put on, 50 basis point or 100 basis point starter positions and turn them over more quickly as my view on them changes, or let them run, if the thesis is playing out as I expected. So it really depends on the thesis. Most of the portfolio, like I said, is in cores. So most of the portfolio is in slower moving stuff.
In your fund, do you use leverage or do you short?
The way I think about leverage, no. Is shorting leverage? Yes. Is going above 100% gross total exposure? Yes. Have there been times where we've done that? Yes. When I started the fund, our gross was much lower. I kind of wanted to prove to myself, again, most of my net worth is in the strategy, and I wanted to prove to myself that I know how to manage risk before grossing up. And so we started with probably 75% being 75% invested on the long side, maybe 25% on the short side, which was not over 100% total gross. But now, as the fund has kind of proven itself and as I've gotten more conviction in the portfolio, the long book sometimes is 90, 100% invested. And then, yes, we do have shorts, which brings the overall gross above 100. Not, we don't take gross to 200. I don't think we've ever been, 180, 200 or anything like that. But have we been 120, 130? Yes. And that's longs plus shorts for your listeners who aren't familiar with how that's expressed. And then leverage. And other than that, the other form of leverage would be options. And yes, we do play in options sometimes. The options that we buy tend to be more opportunistic type positions in nature. So it could be SPAC warrants. It could just be options if we have a specific view on kind of a short term situation where we think we can make 5x or more, like I said, because that's an opportunistic type bet. Or sometimes we use options as stock replacement on the core side for big liquid names that have long dated leaps, for example. We'll sometimes buy deep in the money calls. And then, we consider the delta on that. So, like, we don't look at how much we have in premium. We look at how much exposure we actually have at market prices, a specific name. And so we'll delta adjust everything and look at it on that basis. We're not running on a delta adjusted basis 200% or anything like that exposure. So everything I said before talking about options holds true, including our options exposure.
Now, this is my favorite part of the interviews. Can you talk about maybe one or two of your either favorite themes or favorite names?
A theme I really like right now are these, what I term them to be secular cyclicals. I think the general market view right now is that, we've kind of recovered from COVID. We're kind of at peak demand. Supply chain issues and inflation are going to hurt COGS, labor costs, and material costs. And so we're at peak demand and costs are going to go up. And so, not only could our revenue is going to be challenged, but margins are going to be challenged, and anything cyclical is a sell basically. And I'm sympathetic to parts of that thesis. Um, but because of that, it's created opportunities in some cyclicals that I believe are secularly growing in nature. And so what that means is, yes, these types of businesses, if the economy is down next year, they will be down undoubtedly. But, over time, the economy kind of chugs along at 2 or 3% a year GDP. And these businesses outgrow GDP to a decent amount um, because of their secular tailwind, characteristics that I'll describe in a second. And they do so with very good returns on invested capital and return on equity type profile. So same thing, I look in the cores, I'm looking for well managed, well run, high returns on capital, all the quality characteristics people look for in high quality GARPy names that trade at 25 or 30 times earnings. I'm looking for those same things in secular cyclicals. And so a good example of that I've spoken about at length in various investor letters and other podcasts is Malibu Boats. Malibu is a boat manufacturer. And when people hear boating, they think cyclical because, boating demand is very discretionary. And if the economy is good, people buy more boats. And if the economy is bad, they buy way less boats. And boating demand over the last decade has been pretty flat. Some years it's up, some years it's down. But within that last decade, Malibu's units have been growing at a mid-single digit rate, 4 or 5% a year, even though the boating market has been flat. On top of that, Malibu's been able to increase the price of their boats by, 4 or 5% a year. So their top line in a flat boating environment, and not the best economic environment ever, has grown organically at 7, 8, 9% a year on average. And they've delivered that growth with flat to expanding margins. They've delivered that growth without having to reinvest a bunch of their earnings back into new buildings because or equipment, because they really, what they do is they design, assemble, and market these boats. Um, they don't have these huge manufacturing, built plants or anything like that are very capital intensive. Um, they design, they buy the parts, they assemble, they market. The brand is very important, and so like they've been able to take their earnings and cash flow that the business generates, which it generates a lot of it, and use it to do really smart acquisitions, to add components to their boats, to buy new boating lines that they're able to kind of improve the profitability of. And so they've been able to grow their earnings per share at 25, 30% a year for the last 5, 6 years. And I think it's a business that will probably be able to grow its earnings per share at a very attractive rate for the next 3 to 5 years. And it trades today for 8 times earnings because people are worried about us being at peak everything. In fact, they're not at peak anything because they have so much demand for their boats right now that they said it's going to be until fiscal 2023 before they fill all the demand, right? Because they're backed up on the supply chain side. So, maybe after 2023, overall boating demand sucks and the economy sucks, and maybe they have a down year, but it's not going to be a huge down year. They can protect their margins. On the way down, they've said on earnings calls before that, volumes could be down 80 or 90% before they would be break even, not lose money, break even. Um, they have a negative working capital dynamic where they can grow, capital efficiently. And so this is a type of business that I think can probably hold its multiple over 5 years, can probably grow earnings per share at, 20% a year, maybe more. And if that's the case, it holds the multiple. I make 20% a year on my investment. But the reality is, the longer they grow earnings at that rate for, the more likely they are to re-rate. And so it's not unreasonable to think that they grow their earnings per share at 20% a year and they eventually trade at 14 or 15 times earnings, God forbid. And so that's how you get to a stock that, you're up 4x on over 5 years. And people are like, man, how does a boating stock go up 4x? Well, they double their earnings and they double their multiple. And so I have a few of those that are what I call cyclicals, secular cyclicals. They all are very well run. Management teams are snipers. I mean, they're just amazing capital allocators, amazing at running their businesses, well capitalized. They don't have a lot of debt. If we do go into a prolonged downturn, They're not going to have to issue a bunch of equity or sell divisions or anything like that. And so I'm going to hold my nose and hold through that downturn if it comes, because I really believe over 3, 5, 10 years, it's going to be a much bigger business. Um, and much more profitable. Specifically, going back to Malibu, I forgot to touch on one thing. The segment of the boating market they play in is ski and wake, which is a three-player market. There are three players that basically sponsor all the ski and wakeboard competitions. They've been, not only do they sponsor the professional ski and wakeboarders, but they've spent the last 50 plus years designing the perfect wake, because if you're water skiing, you want a very flat wake. If you're wakeboarding, you want a very curved wake. And so not only do they have the professionals kind of sponsoring their brand, but they also have the actual know-how of how to design the best wakes. And so you have these wealthy people who are $1 million net worth type people who are buying these pretty expensive speedboats. Malibu's average ski and wake boat is $110,000. They go up to 250, 300,000. So these are wealthy buyers, and it's just inconceivable for me to think that that wealthy buyer is going to buy a Toyota because it's cheaper, right? Their neighbors are going to judge them if they don't buy a Mercedes, and their neighbors on the lake are going to judge them if they buy anything other than one of these three brands. And so there's real brand power to this subsegment of the boating market. So like, not only is it this ski and wake outgrowing the broader boating market, but these guys are going to capture that growth through unit volume and pricing, and they're not going to compete on price because, again, it's three players, they're rational, and so those are the types of dynamics I really love. I mean, that's a theme I really enjoy playing right now.
Does Malibu have public market comps?
Yeah, there's one. So it's only a three-player market. This one of the players is Mastercraft. They're public as well. I used to own stock in both, but now I'm just in Malibu. But I think both are great businesses with great product and are going to do well. If the theme works out, I think they'll both do very well over time.
Do they both have similar multiples right now?
Mastercraft has a lower multiple. Malibu is like at 8 times earnings, and Mastercraft is probably at 6 times earnings, which sounds like a big difference. 6 versus 8 is a big difference, but I think Malibu's earned that higher multiple since they both came public around the same time, within 6 or 12 months of each other. Since that time, Malibu has, and they play in the same end market, so like they should have the same headwinds and tailwinds. Malibu has outgrown its earnings on a per share basis in a very meaningful way compared to Mastercraft. Mastercraft has made some acquisitions that haven't panned out exactly how they thought. They had some management turnover. The old CEO left at a very bad time for the company when the channel was their dealer channel was very full of inventory, and kind of left them high and dry at a very bad situation. The new CEO was a former board member who took over the CEO position. And my understanding is there wasn't really a broad search run, even though they said they were going to run a broad search. And so that was kind of a little bit of a yellow flag for me that he took over without any real competition for the job. And then they've made some other growth investments that I think will pan out well for them, but it's just unclear what the payback is and how they thought about those growth investments. Whereas with Malibu, you ask them very specific questions about acquisitions they've done, how they think about payback, returns on capital, and they just have very thoughtful answers. And so I've been willing to kind of rotate into the slightly more expensive one, because just my interactions with them have led me to believe that there's the potential they continue to outperform Mastercraft. It's not a certainty. They both have the same tailwinds. So maybe Mastercraft will grow at the same rate as Malibu going forward, in which case you'd want to own the lower multiple one, of course. But I think there's a decent shot Malibu continues to outperform them on an operational front, in which case, I think it's a safer place to be. I'm just more confident they're not going to make an acquisition that, turns out to be challenged because they haven't done one like that in the past. I'm more confident they're not going to make an investment that might not pan out. And so I think it's worth paying. For me, it's at least, sleeping better at night owning the more expensive one.
Do a lot of your portfolio holdings, are they of companies that make many acquisitions?
Yes. So my largest position is KKR. It's a private equity firm. all they do is make acquisitions. That's their business, is to buy companies. So that's a very acquisitive company. But that's, I mean, they're in the investment management business. It's not like the management company, the asset manager is doing a lot of acquisitions. They did do one acquisition last year, a pretty big one. Um, but I guess that makes a lot of acquisitions. One of my top five positions is RCI Hospitality, Rick. They buy a lot of other nightclub owners. So in a very accretive way, a lot of their value creation over time has been through smart M&A. Um, Another top five position of mine is Maztec Digital. Um, they've made two really smart acquisitions since 2017 that have basically allowed the company to triple its earnings per share since 2017, um, without taking on debt, really. I mean, they temporarily took on debt to do some of these acquisitions, but they delevered very quickly. And now, they're basically going to end this year in a net cash position, um, in which case they're going to be able to start doing more M&A again. So I'm very optimistic that Maztec will do some smart M&A going forward to help triple earnings again over the next 3 to 5 years. Um, Malibu has made some acquisitions. So yeah, I own acquisitive companies. They tend to be companies that have made small and thoughtful acquisitions, not major transformative acquisitions, um, and where the management team actually think like owners. So they treat those acquisitions not as empire building, ways to get a bigger company. So they could go to a cocktail party and say, my company does $500 million in sales instead of $400 million in sales. But they really think, if I'm putting $100 million into something, am I going to at least have, 15 or $20 million a year of annual profit? Because that's what I want to earn on risk that I'm taking instead of returning that cash to shareholders. I want to earn a high rate of return on that capital that I'm allocating. So they tend to be smaller relative to the enterprise value. They tend to be with an owner's mentality, and very value creative for the companies that I've been invested in so far.
Do you think your background in private equity helps you evaluate some of these transactions? That's the one question. And the second question is, when one of your holdings does an acquisition, how do you look at it?
Anyone who spent a lot of time considering acquisitions and seeing how they've played out over 5+ years, probably is, in a better place to evaluate a new acquisition from a company in your portfolio than someone who's never been exposed to those types of decisions and outcomes. And so I think it's definitely helped. I don't think, you know, it's a must have to play in public equities, because if you study enough public equity stories, you get those same repetitions, right? You see companies make decisions, you follow those decisions over 2, 3, 4, 5 years. You see how they pan out, and there's a little bit of muscle memory from that, and battle scars, and some home runs, and some oh man, how did I miss that, and some what were they thinking. And the more of those you see, I think you kind of have, again, the muscle memory and the repetitions are really important. So private equity helped. I don't think you must be in private equity to be a good public equity investor. And how do I evaluate them? I mean, each one is different. Um, for the most part, the companies that I'm invested in, if they're acquisitive, I very much understand what the characteristics of potential acquisition targets are that they're looking for. And so I know, what the biggest type of acquisition is that they would pursue, how much leverage they would be willing to take on to pursue that, what kind of financial returns they expect out of their acquisitions. And so typically when I see an acquisition from a company in my portfolio, I'm pretty excited, because I tend to be invested in companies that I think are smart in their decisions. And so, when I see them make an acquisition, before I even jump into the details, I give them the benefit of the doubt that a good one came up and that they got it for a good price. Of course, I'll read a press release. I'll do some digging on the target. I've gone to trade shows to kind of do some reference checks on potential target management teams, and I'll go on Reddit message boards. I'll do an expert call here or there, to try to really understand the asset that's being bought. The financial profile of the acquisitions is typically pretty clear. A lot of the bigger companies, they'll tell you what they think the accretion is, or how much EBITDA or earnings the business has that it's buying. Some smaller companies that I own, like Maztec, it's a $200 million market cap. They haven't disclosed completely the financial profile of their acquisition targets, but they do file in an AK the purchase agreements. And so, if they have, Maztec likes to use earnouts, or contingent deferred consideration. And so if you open the 8K with the purchase agreement, you can see what the target is for these sellers to hit their earnouts. And so you can kind of understand what you think they expect the business to generate over the next 1 to 2 years. So that's another way I've gotten comfortable with the financial profile. And then of course, they have to also in their 10K show what the pro forma revenue and earnings of the business would be for their last 2 or 3 fiscal years had they owned that target for the full amount of time. And so you can kind of do a little bit of arithmetic and figure out what the revenue is, what you think the margins are, and what the accretion is. So I do the same type of diligence I'll do on my core positions. I'll do on on the acquisitions that they make to make sure that nothing about the thesis is changing. It's not, management team hasn't gone rogue and decided to become empire builders all of a sudden. But fortunately, these guys, like I said, tend to think like owners and make good decisions. So they've worked out well over time.
Do you speak with management often? Do you is that something you do?
Yeah, it depends on I play in all different types of market caps. The smaller the company, I think the more important it is for me to have a good relationship with management. Um, Smaller businesses tend to, by definition, be riskier. They have less diversified customer base, more supplier concentration potentially. Um, you know, their cost of capital tends to be higher, both in credit and equity markets. Um, and things could change, right? If you have 100 million in revenue and you lose a $5 million customer, that's really bad. But if you have 100 billion in revenue and you lose a $5 million customer, it doesn't matter. And so I think and by the way, these larger businesses tend to be much more well followed and covered by sell side. So like it's less likely I'm going to miss something major as well, or less likely I'm going to have a question for management that isn't already kind of covered in a bunch of sell side notes as well. Whereas smaller businesses, like I might have a question for management that I can't reach out to a sell side guy and ask, what did management tell you? I need to reach out to management on my own and hear the answer directly. So I need to have a line into them. And so, with a company like Maztec, Malibu, LGI Homes, RCI Hospitality, Naked Wines, I tend to have a direct line into the CEO and or CFO for most of these businesses on an as needed basis, and I tend to get in touch with them over 1 to 2 days if I need to, sometimes same day, sometimes next day. KKR, I'll speak to the IR team there, the head of IR, the number 2 IR person. Every once in a while I'll be on a group call or maybe get a one-on-one with a management team member, but I don't need to speak to them all the time. There's not a lot they're disclosing in public or in private to people anyway that they're not disclosing publicly. And, we own Alphabet. I've never had a direct conversation with the management team of Alphabet. So I think it depends on the size of the business. The smaller the business, the more I need to feel like I have access to management in order to make an investment decision.
I wanted to congratulate you on your success with starting and growing your fund. Do you have any kind of helpful tips for other potential managers in starting a fund?
First of all, I'm nowhere near like a great success yet that people need to emulate themselves after me. So I don't want anyone to think that I think that about myself. But I think I'll get there. I've been growing nicely in terms of assets and performance. So both organic and inorganic growth, I would call it. And the way and I have much more confidence today that this is going to be my job for the next 5, 10, 20 years than I did when I started the fund. And the reason I've been able to get to the point from very little confidence that it's going to be a 20-year job for me to a lot of confidence that it's going to be a 20-year job for me is that I kept the overhead of the fund very low. I had kept my living expenses low as well. And I had money saved up. And, I had a strategy that I was pretty confident would work. And so I've been lucky that it has worked. Again, some of that's market environment. If the market had been down, from 2018 to today, the market just was down 20% and stayed there. Maybe people wouldn't want to invest in equities as much. And so even if I had decent performance on a relative basis, maybe I wouldn't be raising money. But so I think there's been some luck, some things within my control. But I would encourage anyone who wants to start a fund, keep your costs low. living and fund expenses. Give yourself a long runway to prove out your strategy and that you can manage risk and manage a portfolio. And, I think putting yourself out there in terms of publicizing your ideas ahead of time so people can follow along and see how you're thinking about things as they materialize and see them play out. So they can, if your strategy resonates with people, I think people are more likely to get confidence in investing with you. I put my quarterly letters out on the website. I put ideas on Twitter sometimes to get feedback, but also just so people can kind of see how I'm thinking about things. And so I think in today's social media, internet world, if you're small and emerging, I think it kind of behooves you to take that approach as well and put yourself out there. And so those are kind of the pieces of advice I'd have for people.
Yaron, thank you very much for joining our program. If any of our listeners want to learn more about you, where can they see that?
Definitely come to Twitter. One Main Capital is the handle. Come to the website, onemaincapital.com. Both the website and Twitter have my email address, so feel free to email if you have any questions or want to talk ideas ever. And look forward to hearing from some of you. Thanks for having me on.
Thank you, and I'll definitely put those links in the description. All opinions expressed by Richard Sosa and podcast guests are solely our own opinions and do not reflect the opinion of Think AEN. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Think AEN and its clients might maintain positions in securities and investment funds mentioned. This discussion does not constitute an offer to sell or the solicitation of an offer to purchase any security or investment product. All information provided herein is for informational purposes only and should not be deemed as the basis of an investment decision or a recommendation to buy or sell the securities mentioned. Thank you for listening to the Riches in the Niches Investor Podcast. And until next time, don't forget to niche down.